Understanding the difference between these two movements right here could be what makes you a profitable trader. Now listen up, because I'm going to be explaining the difference between impulsive and corrective movements, also known as pushing versus exhausting, also known as distribution versus accumulation. There are multiple names for this exact same movement right here, but it's just two different market phases that you need to be aware of and can really highly benefit your trading. Run the intro. What's good, my traders? It's your boy Daniel Fex here. Welcome back to the channel. Now today we're going to be going through the two market cycles that happen literally every single day without fail. Now nothing is guaranteed in this market except these two things right here, and that is just pushing versus exhausting. Now like I previously stated, there are multiple names for this. Some people refer to it from SMC standpoint of view, which is distribution versus accumulation. Some people refer to it from price action, which is pushing versus exhausting. It's all kind of describing the exact same things and the same characteristics of price action. Now if you zoom out on the chart, you'll notice that price is only ever doing one or two things. We're either pushing or we're exhausting. And those one or two things are either up or it's down. Even a sideways movement, which is a correction, is still an up and down movement. Now there's two kind of phases the market pushes in, but for the purpose of this video, I'm going to be referring to it as impulsive and corrective movements. Now the impulsive movements are very easy to spot because they're always the largest movement on the chart. They take place in the shortest duration and they cover the largest distance. Now these are the money making moves. This is the way you want to be focusing your attention on, because this is where the money is at. You're able to be in and out of the market very quickly. You're able to enter a small position and still have a larger gain, and you're able to just overall make more money in general, because this is where the liquidity is at, in comparison to the opposite end of the spectrum, which would be a corrective move. A corrective move is literally what you would expect, and it's price correcting itself. Now this typically takes place in between the impulsive movements, and this is where the market gets a cycle from. Typically it goes from pushing to exhausting to pushing to exhausting, so on and so forth. Now it doesn't always necessarily have to exhaust after it pushes. However, it's a very, very common characteristic that price will retrace or will consolidate after a large pushing phase. For example, you can see that right here we have a large impulsive move to the downside, immediately followed by a extended correction or a staggering movement, followed by another large impulsive movement. So again, price doesn't always necessarily form like this, but this is a great example showing you an impulsive that comes into a corrective that leads back into another impulsive. And this is literally what the market is doing day in, day out. It's always a repetition: impulsive, corrective, corrective, impulsive, 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 corrective, corrective, impulsive, so on and so forth. It's always happening, and you really want to be able to identify the difference between these movements, and you want to avoid the corrective and catch the impulsive. Now what actually is this, and what am I actually identifying? Am I just looking at big ass candles, or is there something more to it? And I'm going to break it down for you here in a second. So these right here are the characteristics of a large impulsive movement. Now typically speaking, in order for a move to be classed as an impulsive movement, I would say that you need three strong directional candles. So three or more candles of the same color in the same direction without having a retracement candle. So right here you can see we've got 1, 2, 3. This makes it an impulsive movement. Now the second characteristic you're looking for is you're looking for small wicks and large bodies. Now you can see right here on this movement, this big ass candle that we leave literally does not have an upside wick rejection. And what that's telling you is that price is really certain in this movement. It's not meeting much resistance, there's no uncertainty. It's a very certain full volume movement, and price is just going where it wants to go. Once again, this is where the money is at in trading. Now notice how we're still leaving wick rejections, but relative to the size of the body, the wick rejections are pretty small. Now the final characteristic is you're looking for a large distance to be covered. Now what you consider to be a large distance is going to be relative to the time frame you're trading and the price action you're looking at. But again, once again, blatantly, this is a large movement in comparison to what has previously been happening, and it takes place in a very short duration of time. So once again, you're just looking for those very certain quick movements. Now right here for a corrective move, you're essentially looking for the exact opposite of an impulsive movement. Now you're looking for 3 indecision candles. Now what you consider an indecision candle is going to be relative to you and the price action you understand. But typically speaking, you're looking for 3 candles that are very low volume candles, meaning they have large wicks and small bodies. It's a very, very good indication the price is uncertain. It doesn't really know what it wants to do. It's kind of trying to go everywhere, but it doesn't have the volume to go anywhere. So that's why you get the long staggering movements. Now within this movement, you're also going to notice that price doesn't really go anywhere. Now you can see right here, if I actually bring out my measuring tool and I measure this, this is literally 2 days of price action. Bear in mind, we're on Euro USD. It's a very liquid pair, but this is 2 days of price action. And although we do come from here to here, so granted this would be like 30 or 40 pips, it still is some, or even 70 pips, but it's 2 days of price action to cover those 70 pips, which means price really isn't moving that much. And once again, you can still trade these movements, there's still money to be made, but you're going to have a lot harder time trying to make money in this sort of conditions. You're going to be trapped in trades for longer, you're much more likely to be wicked out or to be just taken out of a position over one random wickage or whatever. But all in all, it's just not good to kind of trade this movement, because again, you could be very easily trapped in this trade for days at a time if you're not careful. Now compare this impulsive right here, where we cover about 120 pips in about 7 hours. Still a decent amount of time because it's Euro USD, but it's a large gain in a short duration of time in comparison to almost 2 days of price action, or over 2 days of price action, and price really doesn't do even half the gain that we do. Now really pay attention to the difference. Right, now what actually causes the impulsive movements and what causes the corrective movements? What's the difference between the two? Now there are multiple reasons for an impulsive move to happen. It could be high impact news, it could be just an accumulation of buyers or sellers, it could be a reaction off of a key level or an order block, it could just be a regular price fluctuation. The main point is that you don't specifically know why an impulsive move is happening, it just is happening. Again, I'm not ICT to tell you why the market is moving. I simply react to price action and make decisions based off of what I'm seeing. Now, typically speaking, these impulsive movements take place usually around session open or session closure. You're not going to find an impulsive movement during Asia session. You're not going to find it out of session. You're not going to find it when it's bank holiday. It needs to be a high volume period. And again, usually session open or session closure is when these kind of moves take place. Now, equally, a consolidated period, corrective movement like this will typically take place during a low volume session. So once again, this is a very, very common characteristic of Asia session. This is one of the reasons I've never traded Asia session in my life, because usually you get price action that looks like this. Again, if it is some sort of holiday, for example, bank holiday will usually be a corrective. If you had a large impulsive movement, again, this is not always the case, but if you have a very large impulsive movement, typically speaking, the day after or the next couple of candles of price action will be some sort of corrective, because price cannot just move in one direction forever. At some point, it needs to come back. Now, again, you do have certain scenarios, and I have seen this a couple of times in the markets, where you will have an impulsive, and an immediate impulsive back away. But again, usually this sort of formation right here is a direct reaction off of a level, off of an order block, off of something that has made price do this. It doesn't just happen out of nowhere. But typically speaking, I would always kind of anticipate a correction after an impulsive movement. Now, a little exercise for you newbie traders. If you're still getting into this market, you really want to have this be second nature. You want to be able to identify these impulsive and these corrective movements without having to think about it, because they genuinely take place every moment, every minute of the market, on every single time frame. Every time frame is fractal, so you're going to see it on the hourly, the 5 minute, the 30 minute, the daily, the weekly. It doesn't matter, it's always taking place. So I'd recommend spend a bit of time on TradingView just identifying impulsive and corrective. For example, impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, corrective, and what? Another big ass impulsive. Again, the market is literally always doing this. It's one or the other. There's no in between. There's no half corrective, half impulsive. We're either impulsive or we're corrective. Now, really spend some time on the charts and just make this stuff really second nature, and I promise you your trading will improve. But that's it for the video. Let me know if you enjoyed this. I'm going to be back in the next one. We're going to continue the price action mastery lessons. We're going to continue to build off of this concept and learn a little bit more about price characteristics and market sentiment. See you in the next one.